Hi, my name is Tang. Hope you're doing well and welcome to the channel. So in this video, I want to describe a US government savings bond that is currently paying over 7% interest right now, which is just mind-blowingly crazy. To put that in perspective, some of the best high-yield savings accounts out there, like Ally Bank and Capital One, only offer between 0.4 to 0.5% interest, which is just extremely low, and you're guaranteed to lose money to inflation. In fact, the annual inflation rate from October 2020 to October 2021 was 6.2%, which is crazy high. Now, not only is this bond that I'm going to be talking about in this video fully backed by the US federal government, so a very low risk type of investment, but it will also always keep up with inflation long term over several decades, while also paying you a small tip on top of it. It's highly tax efficient and even viable as a long-term emergency fund for everyone ranging from young investors to retirees. So without further ado, let's begin the video. Now, the government bond that is paying over 7% interest right now is the Series I savings bonds. These are non-marketable bonds issued by the US Treasury, so they can only be bought and redeemed on the Treasury Direct website. This means that you can't do any buying or selling on secondary markets or through apps like Robinhood or Webull. And what's amazing about these I-bonds is that it offers significant inflation protection, and it does so via the calculation of its composite rate. It combines a fixed interest rate with a variable inflation rate that is adjusted semi-annually. And the second variable is really important because it follows the consumer price index, which is how we typically calculate inflation. For example, right now, the fixed interest rate is 0%, partly because the Federal Reserve slashed interest rates at the start of the pandemic. Additionally, since the economy was struggling in 2020, the US government also provided a lot of economic relief via stimulus packages and purchases of bonds and mortgage-backed securities. Supply shortages included, and we're now experiencing a time of relatively high inflation. As a result, the semi-annual inflation rate right now is pretty high at 3.56%. So when we plug and chug these numbers into the composite rate formula right here, we get over a 7% return on our I-bonds until at least April of next year, April 2022. And if inflation continues to remain high for several years, that's completely fine, since these government bonds are designed to automatically adjust to keep up with inflation. Now, although the fixed interest rate is 0% right now, that wasn't always the case. Back in 2019, the fixed interest rate was actually 0.5%, which isn't bad considering that you were earning this 0.5% return on top of keeping up with inflation. And if you held these bonds since 2001, you could be earning over 10% in guaranteed interest right now. And keep in mind that the interest is compounded over time, allowing you to build wealth while maintaining your purchasing power over many decades. What's also great is that the composite rate can never go below 0%. So if we ever enter a deflationary economy and the negative inflation rate outpaces that fixed interest rate we get on the I-bond, we won't lose any money because our composite rate can never go below 0%. It's really cool stuff, and it further protects you in a deflationary economy. Your money can only go up or sideways, never down. That being said, because I-bonds are so powerful, the government only allows a maximum annual purchase of $10,000. You could actually invest a lot more through owning a trust or buying paper bonds, but those deserve a separate video because they tend to be a bit more complicated. Another key limitation of I-bonds is that the money is locked in for 1 year. So if you anticipate needing the money to, say, buy a car, buy a house, or make any other large purchase within the next 12 months, I would personally absolutely stay away from I-bonds because that money is locked in, and I would look instead at high-yield savings accounts even though they offer a much lower return. Additionally, if you cash the bond out after fewer than 5 years, so between 1 and 5 years, you would sacrifice the last 3 months worth of interest, which is very similar to how CDs work. The I-bonds also accrue interest for up to 30 years, so many individuals will begin redeeming these bonds when they hit retirement age. Now, the last and probably biggest limitation of I-bonds is that you can only purchase and sell them via the Treasury Direct website. And as with most government websites, it can feel a little outdated and difficult to use sometimes. But if you are holding on to excess savings that you won't need in the next 5 years, I-bonds are simply a great investment tool to earn high rates on low-risk assets and can protect you against inflation for the next several decades. There's also significant tax advantages when it comes to I-bonds. The interest you earn is exempt from state and local taxes. You can also defer federal taxes until you sell the bond, or until the bond has reached its final maturity date of 30 years. And this is great for many retirees because they tend to be in lower tax brackets than when they were full-time workers. So this can actually save quite a lot of money in tax savings over many decades. Finally, the bond interest can sometimes even be tax-free at the federal level when you use them to pay for higher education, thereby saving you even more money and allowing your children or future children to stay away from student debt. For me personally, given that I am a young 22-year-old investor, I still think that Series I savings bonds can work as a great long-term emergency fund that works really well if you also have a high-yield savings account for more short-term expenses and goals. And I personally even put down $10,000 of my own money into these I-bonds to earn that amazing 7% interest rate right now and to protect my savings against inflation over the next several decades. Now, most of my money is still heavily invested in stocks and cryptocurrency, but I'd like to have a safety net of about 1 year worth of expenses held in both I-bonds and a high-yield savings account. So with all that being said, thank you all so much for watching. I'd love to also hear your thoughts down below as to whether I-bonds are a great fit for you personally. If you enjoy this type of content, please feel free to tap that like button, subscribe for more personal finance, and I'll see you in the next video. Stay safe, stay healthy, stay awesome. Take care.